In this video, I'm going to show you exactly why your current structure is likely bleeding money, what the IRS actually sees when they look at your entity, and how to fix it. Let's get into it. You set up an LLC because someone told you it was the smart move. Maybe it was a friend. Maybe it was a Reddit thread. Maybe it was your cousin who knows a guy. And now you're sitting there with this LLC thinking you're protected, thinking you're optimized. And meanwhile, the IRS is looking at your setup and seeing one of the easiest targets on their list. Here's what nobody told you when you filed those formation documents. And an LLC does not determine how you're taxed at all. It's a legal designation, not a tax designation. And that one misunderstanding, it's probably costing you somewhere between $15,000 and $30,000 a year in taxes you don't need to be paying. In this video, I'm going to show you exactly why your current structure is likely bleeding money, what the IRS actually sees when they look at your entity, and how to fix it. Whether you're running a traditional business, earning crypto income, or building something entirely digital, I'll show you what a defensible structure actually looks like. One that holds up if you ever get that letter from the IRS. Let's get into it. Let's start with the thing almost everyone gets wrong. You formed an LLC, but how is your business actually being taxed right now? Most people can't answer that question, and that's the problem. When you form a single member LLC and don't make any tax election, the IRS doesn't see an LLC. They see a sole proprietorship. That means you file on Schedule C, every dollar of profit gets hit with self-employment tax. That's 15.3% on top of your income tax, and you have zero separation between your business and personal finances in the eyes of the IRS. And if you formed a multi-member LLC, same issue. The IRS defaults into a partnership, which means you're filing on Schedule E and you're still paying self-employment tax on all of it. The LLC itself, it's a legal shell, a liability wrapper. It's great for asset protection, but it tells the IRS absolutely nothing about how to tax you. That decision is a completely separate choice. And if you didn't actively make that choice, the IRS made it for you, and they chose the option that costs you the most. So here's what most people don't realize. You have the power to tell the IRS how your LLC should be taxed, as an S Corp, as a C Corp, or yes, as the default sole proprietorship or partnership. Almost nobody does this because almost nobody understands this exists. Your LLC is not your tax structure. It's your legal container. And the tax structure inside the container is what actually determines how much money you keep. Now you might be thinking, okay, so I'm technically a sole proprietorship inside my LLC. How bad can it really be? Let me show you. Let's say you're earning $150,000 in net profit from your business. As a sole proprietorship, here's what happens. First, you pay income tax. Let's call that roughly $30,000 depending on your bracket and deductions. Then on top of that, you pay self-employment tax. That's 15.3% on the 92% of your net earnings. On $150,000, that's roughly $21,000. Just for the privilege of being self-employed. So you're handing over $51,000 on $150,000 of income. And here's the part that really hurts. A significant chunk of that $21,000 in self-employment tax is entirely avoidable with a different entity election. But the tax hit isn't even the worst part. The worst part is the audit risk. Sole proprietorships filed under Schedule C have consistently higher audit rates than other business structures. And there's a specific reason for that. When you file as a sole proprietorship, the IRS only gets an income statement, your revenue, and your expenses. They don't get a balance sheet. They don't see your assets, your liabilities, or your equity. It's a one-sided picture. And when the IRS can only see half the story, they don't trust the story you're telling. A corporation, whether S Corp or C Corp, files full financial statement, balance sheet, income statement, sometimes a cash flow statement. The IRS can cross-reference everything. That transparency actually works in your favor because it gives them fewer reasons to dig deeper. So if you're operating as a sole proprietorship inside your LLC right now, you're paying maximum taxes and facing maximum scrutiny. That's the worst of both worlds. So what's the first move most business owners should consider? And more importantly, how much can it actually save you? For most active business owners, meaning you're working in the business, delivering the service, creating the product, the S corporation election is the single most impactful tax move you can make. Here's how it works. When your LLC is taxed as an S Corp, you split your income into two buckets. Bucket 1 is your salary, a reasonable wage you pay yourself for the work you do. Bucket 2 is your distribution, the remaining profit that flows through to you as the owner. Here's why this matters. Only your salary is subject to payroll taxes. Your distributions are not. On that same $150,000 of profit you just saved, over $10,000 in a single year, the number gets more dramatic as your income grows. At $250,000, you could be saving $15,000 to $20,000 annually. And there's a critical detail most YouTube videos skip over. That salary has to be reasonable. The IRS specifically watches S Corp owners who pay themselves an artificially low salary to minimize payroll taxes. If you're a consultant earning $250,000 and paying yourself a $30,000 salary, that's a huge red flag. The IRS has successfully challenged unreasonable salary positions in court multiple times. This is when having someone who understands defensibility matters. Your salary needs to be justifiable. Document why you choose that number. Benchmark it against industry standards. Create a paper trail that holds up under scrutiny. Because if you can't defend the salary split, the entire S Corp advantage disappears, and you might owe back taxes plus penalties. There's another benefit most people overlook. As an S Corp, you're now filing 1120S, which requires full financial statements. Your balance sheet, your income statement, everything is reported to the IRS. And as we discussed, that transparency actually reduces your audit risk compared to a sole proprietorship. So the S Corp doesn't just save you money, it makes your entire financial position more defensible. Now, the S Corp is powerful for active business owners who take most of their profits out. What if you're building something bigger? What if you're reinvesting more of your revenue back into the company? That's where the C Corp becomes interesting. An S Corp is a pass-through entity. All income flows through to your personal return. It gets taxed at your personal rate, which could be as high as 37%. C Corp is taxed at entity level, and the corporate tax rate, flat rate of 21%. So if your business earns $250,000 and you're reinvesting $200,000 of that into growth, hiring, infrastructure, equipment, R&D, a C Corp lets you keep that reinvested capital taxed at 21% instead of your higher personal rate. That difference compounds dramatically over time. And there's a provision in the tax code that most business owners have never heard of. Section 1202, Qualified Small Business Stock Exclusion. If you hold C Corp stock for at least 5 years and meet certain requirements, you could potentially exclude up to $10 million in capital gains when you sell. That's not a deduction, that's an exclusion, meaning you would pay 0 federal capital gains tax on the sale of your business. Now, the C Corp has a well-known downside. Double taxation. The corporation pays tax on its profits, and then when those profits are distributed to you as dividends, you pay tax again. That's real. But here's the thing. If you're reinvesting and not taking distributions, that second layer of tax doesn't hit. And if you're planning to sell the company eventually, Section 1202 can eliminate the capital gains entirely. C Corps also unlock fringe benefits that S Corps and sole proprietorships can't touch. Health insurance, educational assistance, dependent care. These can be deducted as business expenses for C Corp employees in ways that simply aren't available to other structures. Now, here's where I need to tell you something that almost nobody in the entity structuring conversation is talking about. And it's the thing that makes this decision dramatically more complex for a huge segment of business owners today. If you hold crypto, earn DeFi income, receive staking rewards, mine tokens, or operate any part of a business on chain, everything I just explained to you gets a layer of complexity on top of it that most accountants are not prepared for. If your LLC holds crypto assets and you haven't made a tax election, you're a sole proprietorship with digital asset exposure. That means every token swap, every staked reward, every airdrop you receive, it's all taxable income, and it's all hitting on a Schedule C with maximum audit risk and 0 separation between you and the assets. But it gets worse. Most crypto platforms don't report cost basis to the IRS. Your exchange gives you a 1099 showing proceeds, what you sold for. They often don't report what you paid for it. So the IRS sees income, but they don't see your costs. And if you can't prove your cost basis with documentation, the IRS can assume your basis is 0. That means they can tax you on the full sale amount as if it were all profit. This is where entity structure and accounting infrastructure intersect. If you're holding crypto inside an entity, whether that's an S Corp, C Corp, or an LLC taxed as a partnership, you need lot level cost basis tracking. That means knowing exactly which tokens you bought, when you bought them, what you paid, and which identification method you're using. And here's the thing most people miss. The method you choose can dramatically affect your tax bill. FIFO, for example, sells your highest cost lots first, which minimizes your reported gains. But you need to be consistent, and you need documentation proving which method you elected and when. If you switch methods mid-year without proper documentation, that could be an audit problem. Now layer on staking rewards, which the IRS treats as ordinary income at the time of receipt. Layer on airdrops, income at fair market value on the date received. Layer on DeFi protocol interactions where wrapping, unwrapping, and liquidity provisions may each be separate taxable events. None of this is theoretical. This is what actually happens when you file taxes with crypto exposure. If your entity structure and accounting systems aren't built to handle this complexity, you're not just losing money, you're creating an indefensible position. I've been throwing around a lot of concepts here. Let's make this concrete. Let me show you what 3 different entity structures actually cost a real business owner, and I'll include the crypto layer so you can see the full picture. You run a digital service business. You earn $250,000 in net profit. You also have a crypto portfolio that generated $30,000 in realized gains and $10,000 in staking rewards. This total taxable activity, $290,000. So let's go through scenario number 1, sole proprietorship. We have self-employment tax on $250,000, $35,000. We have income tax on $290,000, and that's business and crypto. That would be $58,000. Crypto with no cost basis documentation is challenged by the IRS. Total tax, potentially $93,000. You keep $197,000, and your audit risk is potentially very high. Scenario number 2, S Corp election. Reasonable salary, about $100,000, you pay payroll tax, and that could be $15,300. Distribution of $150,000, no self-employment tax. Crypto gains and stake gains reported on your personal returns. Income tax on $290,000 in total is about $55,000. So your total tax here is $70,300. You keep $219,700. Audit risk is moderate because you filed full financial statements. Scenario number 3, S Corp, C Corp layer structures. S Corp for active business income, salary plus distributions. C Corp, subsidiary for reinvested capital and certain benefits. Crypto held at entity level with documented cost basis tracking. Total tax is about $58,000. It varies based on reinvestment allocations. You keep about $232,000. Audit risk? Low. Full documentation, multi-entity transparency. It's a $35,000 annual difference between the worst case structure and a properly architected one. Over a decade, that's $350,000, and that's before accounting for compounding investment returns on the saved capital or the value of reduced audit exposure. And here's the thing I really want you to hear. The dollar savings only matter if the structure is defensible. If you set up an aggressive S Corp salary split without documentation, or you layer entities without a clear business purpose, you're not saving money, you're creating future liability. This is the difference between tax optimization and tax architecture. Optimization finds the lowest number. Architecture builds the structure that holds up under examination. So the question isn't just which entity saves me the most money. The real question is which structure gives me the best combination of tax efficiency, audit defensibility, and financial clarity. And that answer is different for everyone, but here's the framework we use to evaluate it. Step 1 is understand your income sources. Is your income active or passive?